Good morning, everyone. Welcome to this update for global stocks and commodities for the 2nd of December. My message to you this week is to keep it simple, because we've had a period now since the start of October where the market got really fearful about a couple of things, and I'll come back to that. And we've had a pretty rugged trading period during that time. But now two events occurred last week, or one occurred early in the week with the US Fed. And then there's been a very positive outcome to the G20 meeting between Trump and President Xi from China, and certainly that has now removed two of the significant fears that the market had. So I think we're going to see an extremely strong open to the start of trading, both around the world, starting tomorrow. It's very difficult in these sort of circumstances when sentiment is going from, full-on negative to full-on positive, as I'm sure we'll see in the early stages of next week. It's very difficult to be making adjustments. So you've just got to keep your game plan very clear, keep it simple, focus on the sort of stocks that I've been talking about through this video service for years and years, and just focus on buying the dips and just keep it really simple. If you get too close to the action and get drawn into all of the massive swings that we're seeing in commentary around the market, it just gets really difficult. So that's the message for this week. So in this update, this time last week, markets were in trouble. They looked ugly. A breakdown looked to be the path of least resistance. And now both major fear points have been significantly reduced. But I must point out that there is a global slowdown occurring outside the US, particularly in Europe. So that's one that's certainly not to be dismissed. And Japan is still struggling to a degree as well. We'll do the normal stock and commodity trend update. And last week in Portfolio Analyst, I introduced I did a recap. I'd already introduced it several months ago, but a strong buy in the Australian human services area that there's a lot to like about this particular company. So turning to American stocks, the S&P index bounced hard by nearly 5% for the week anyway, and that was not unexpected because markets had been oversold, and we were at towards the bottom of the range on the S&P, as you'll see in a minute. So that bounce was to be expected, but it was certainly helped along by the comments that the Fed Chairman Powell made, and that was to really soften his stance from what he'd said in October, which was that they were a long way from neutral setting on interest rates, and he amended that quite a lot to be that they're just below. Now, whether that was the pressure put on by Trump or whether the economic circumstances have changed, we'll never know. But the effect has been to, as in traders' minds, put a bit of a floor under the market, because the market was concerned about interest rates rising too quickly. And certainly his announcement has put paid to that. So that was one of the fears. The second fear, of course, was the trade war, and it would appear, at least on the surface from the reports I've read this morning, that China and America have basically determined as of January 1 that they're going to wind back the tariffs completely, if the reporting that I've seen from the South China Post is accurate. So this is an amazing de-escalation. I don't think anyone saw this coming. Perhaps it was part of Trump's plan all along, but this has been an amazing turnaround. So that's going to be another huge positive for the market. Now, the short sellers got caught out by the change in Powell's language, and that's why we saw such a sharp rebound in the S&P of nearly 5%. And next week they're going to get fried good and proper, because I think this de-escalation of the trade war is going to be even bigger news than the Fed announcement on interest rates. Now, markets are incredibly hard to determine in the short term these days, because there's so much computer algorithm stuff that's driving the markets. But you've got to expect that Monday's is, I think, going to be a pretty huge day. So after that, who knows? US dollar was a little bit higher on the week, not by much, but we did see the high yield debt ETF rebound. And strangely, we also saw the 10-year Treasury yield ease back a little bit further, which sort of supports what Powell is now saying. So perhaps the US 10-year Treasury had already moved down in anticipation of the Fed backing off a little bit. Who knows? Anyway, let's jump in and take a look at the market. So we'll start with the S&P, and you can see very clearly the range that we've been in between 2600 and 2820. Last weekend we were down here right at the bottom. There was a chance that we'd always get a bit of a rebound anyway, and then Powell's comments, of course, really fired things up. Now Monday, I haven't seen any futures yet, of course, because they're not trading, but I wouldn't be surprised if the S&P didn't open up above 2800. And if it can close next week above this 2820 mark, then I think we're back in positive mode, well and truly. So that's a line in the sand. Now, you shouldn't ever take any level as being absolute definitive. And once the market gets above it, then of course it's just going to roar off. But it serves as a pretty useful reference point to determine the sentiment of the market. So I would my expectation is we'll get a big jump in the futures on the opening on Monday. But let's see how it finishes the week. That'll be the key in my mind. Now let's just look at HYG. So we had a breakdown of the high yield corporate debt. This was an important level here at around 83.7. We broke that quite clearly, and we broke it on some substantial volume. We've now rallied back to it. I'm not quite sure how the credit markets are going to take the outcome of what's just happened in Argentina. I don't have a feel for that at all, so we'll have to watch and see. But certainly the credit markets have not. Yes, there was a breakdown here, but the credit markets didn't really get into trouble. We didn't see any major moves, so I don't think the credit markets were too concerned about what was going on. Now let's just look at the 10-year Treasury yield. So we've eased back, as you can see. We had a minor breakout, which turned out to be a false breakout. And I would think that we're perhaps going to pull back a little bit further. Perhaps we'll stay under 3% for a little while now that the Fed appears to be backing off. So that's the market situation in both equities and credit markets. Let's just look at the currency. So the US dollar did manage a slight rise, and we are still in medium-term uptrend. We're in short-term uptrend, and that's pretty much it. Turning now to the Aussie dollar, and we're in short-term uptrend on the Aussie dollar as well. Finished the week at 71. So just to recap. The Aussie dollar up to 73.01. The ASX 200 was down by 50 points on the week, which was just under 1%, but I think that will certainly turn around on Monday, and I wouldn't be surprised to see the Australian market up by somewhere between 1 and 2% on Monday. Energy and banks were the major drags on the index, and we can expect a pretty good day tomorrow. But after that, I really don't know, because if you look at, let's go and look at the Australian market. So there's the ASX 200. So we're still struggling. We're right at the bottom of the range on an important support level, and we're fluctuating between 5,600 and 6,000 since we had the breakdown in early October. If you look at now energy, which is obviously in a very, very sharp decline thanks to the oil price being off by more than 30% in just a handful of weeks. So energy a real drag, but also banks are also not helping the index as well. You can see we've got a consolidation range here. And the Australian banks, I think, are going to trade quite differently to many of the global banks for a number of reasons that I've discussed many, many times. So the 200-day moving average is pointing down. The index is well below that moving average. And looking at the landscape for the Australian banks, it's really difficult to see what's going to get them, back up here, 6,500 points on the sector index. I just really can't see what's going to drive it up there. So I think the Australian dollar is going to remain below 6,000 points for some time now. Precious metals, gold basically unchanged at 12.23, and the line in the sand for me, we need to see it close above 12.45, and hasn't been able to do that yet. And the same with precious metal stocks, really no change there at all. So I won't bother looking at the charts this week. We did see the local gold producers under a bit of pressure last week, particularly towards the end, and I think that's quite possibly related to the fact that the Australian dollar's gone up, which has reduced the Australian dollar gold price. So I think that's probably what put a little bit of a lid on the local producers. Turning to other commodities, copper was up another cent. LME inventories still in downtrend, and so no sign of a reversal there, despite the fact that global growth is certainly coming off in Europe, that's for sure. Crude oil stabilised just under 51, so a slight rise for the week, but that was after it had broken $50. And we saw crude oil inventories in America rise for the 9th straight week. So there's really no short-term improvement in sight for crude oil. There's the copper chart. It's just been really trading in a very tight range there around the 280 mark. And there's the inventory levels in the London Metals Exchange. So only a slight decrease for the week, and we're very close to 5-year lows, but we're certainly not seeing any sort of turn up at this stage. And there's crude oil. There's crude oil. So we're just finding a couple of weeks of stability, but we're not out of the woods yet on crude oil. So to wrap it up, I think the big news event for Monday is the trade war truce, which is how it's being portrayed. Is it sustainable? I don't know. Trump is unpredictable. I can't imagine that China is going to back off easily because these are important issues for them, for their long-term planning. They're important issues for America. The two of them are struggling for global control, and I think that's going to continue. So, how sustainable that announcement is, we'll have to wait and see. And that's why, making radical changes to your portfolio is going to be challenging. I think we're going to see a substantial initial reaction. It's going to be overwhelmingly positive, but what happens after that will be very interesting to see. And other than the runaway US deficit situation, which will become a significant problem at some stage, but as I've said, it could be 2 years, 5 years, 10 years away, who knows. Most other elements in America are fine in terms of the economy, the employment rate. Over the last 6 or 8 years, we've seen a lot of part-time jobs be replaced with full-time jobs. The unemployment rate is now at a very, very significant low, 3.8%, basically full employment. We've got corporate profits have done magnificently well due to the tax cuts. That huge boost will disappear next year, but nevertheless, the corporate situation seems to be pretty good. The other concern for the US market was the rate of interest rate increases and how that would affect corporate profits and overall business activity, but that now seems to have been watered down quite significantly. So, things are looking pretty good. The US is there's no question about the US is benefiting from a pro-business agenda. The reduction in tax rates and the stimulus to business has just done wonderful things for the American economy. And whilst not everybody is necessarily benefiting to the same degree, I think if you want to look at it from the other perspective, no one wins from a stagnant economy. And in Australia, I believe, despite what we're being told, there are plenty of signs that we've got a stagnant economy, and we don't have a pro-business agenda here, either from the coalition or from Labor or any other part of the Australian Parliament. It's a huge problem. It's making us globally even more uncompetitive than we've been for probably the last decade, and we just need some vision. We need a shift in this country. Otherwise, we're just going to continue to fall further and further behind. And I think the US is demonstrating just how much positive you can bring to the economy if you've got some politicians that have got some guts. Whether you like Trump or not, there's no question that he's certainly done a lot of positive things for the US economy. Portfolio analyst this week. I was going to do this anyway before the announcement of a truce on the trade war. Just really looking at the opportunities in the high PE super growth stocks in Australia in particular. But now that we've got this trade war truce, I'm sure they're going to get another leg up as well, because rising interest rates was one of the things that was impacting on these very high PE stocks. So it'll be very interesting to see how the market now treats these high PE stocks. So I'm going to be looking at that in Portfolio Analyst this week. If you haven't taken the $1 trial yet, then of course that's available for you to do so. There's my contact details for anyone that is not a member of any of the services, and I think this is going to be a absolutely fascinating week, so I look forward to being with you next Sunday. Cheers.